As of right now, on Friday, May 15th, 2026, the markets are open and humming with activity. SoFi stock is currently trading at $16.02, showing a strong intraday push of about 4.6% from its opening levels. If you have been watching the tape today, you have seen a significant amount of volume pouring in, pushing the price through some key resistance levels that have held this name back for weeks. While the broader indices are navigating a mix of macro data, SoFi Technologies is managing to carve out its own path today, catching the attention of both retail traders and institutional desks. Now, here's the thing that most people are missing today. The common expectation for SoFi is that it lives and dies by the interest rate cycle, that it is just another high-growth bank waiting for the Fed to save it. But the reality is actually much more interesting. While everyone was debating rate cuts, SoFi quietly closed a deal to acquire PrimaryBid, a UK-based fintech firm. This move is a total shift in their business profile. It means they are moving aggressively into the global capital market space, giving retail investors access to IPOs and corporate debt in a way that used to be reserved for the big institutions. This is not just a student loan company anymore. It is becoming a global infrastructure play for retail finance. If you thought this was just a neobank, you were looking at the old version of the company. The sentiment around Nvidia stock or Apple stock often dictates the tech-heavy days, but fintech is finding its own legs in 2026. Looking at the intraday action, the volume is actually exceeding the 10-day average, which suggests that this move has some real conviction behind it. We are seeing a lot of activity on platforms like Robinhood and Interactive Brokers, where the retail crowd is leaning heavily into the long side today. It's a classic tension between expectation and reality. People expected a slow grind, but the reality of their diversified revenue streams, especially that record Q1 revenue of over $1 billion, is finally starting to settle in. When you look at the landscape of online investing, you see a lot of competition. You have the heavyweights like Fidelity and Schwab Intelligent Portfolios fighting for every dollar of managed assets. Many people use those investing sites for their individual brokerage needs because of the perceived safety of a legacy brand. The expectation is that the old guard will always win on trust. But the reality for SoFi is that they are seeing record member growth, now sitting at nearly 15 million members. They are not just getting customers, they're getting power users who use multiple products. When someone starts with a loan but then moves their cash management and their online investment accounts to the same app, the lifetime value of that customer skyrockets. Let's talk about the institutional side of things for a second. We are seeing a lot of rotation out of some of the standard Fidelity ETFs and even some Fidelity mutual funds as investors look for more aggressive growth in the fintech space. While Fidelity Wealth Management remains a titan, the younger demographic is clearly favoring the integrated all-in-one approach that SoFi offers. This is creating a weird divergence in the market. The expectation was that as SoFi became a real bank with its own charter, its growth would slow down and it would start looking like a boring utility. The reality is the opposite. The bank charter has allowed them to lower their cost of funds so much that they can keep their margins high even when they're being aggressive on marketing. Speaking of marketing, you cannot talk about this stock without mentioning the short sellers. There has been a lot of noise lately regarding accounting allegations and the sustainability of their loan book. This is the ultimate tension point for the stock. One side says the numbers are too good to be true, while the other side points to the consistent profitability over the last 10 quarters. If you look at the Fidelity trading platform or even the SoFi trading platform itself, the options chain is pricing in a lot of volatility for the coming months. It's a battleground. Comment below how many shares of SoFi you currently hold, or if you were sitting on the sidelines waiting for the short seller drama to clear up. I want to see if the sentiment here matches what we are seeing in the price action. To understand why the stock is moving like this today, we have to look at what they actually do. At its core, SoFi is a three-headed monster. You have the lending side, which is the old-school bread and butter, student loans, personal loans, and mortgages. Then you have the financial services segment, which includes the SoFi Invest and cash management products. Finally, you have the technology platform, which consists of Galileo and Technisys. This last part is the most overlooked. They are essentially the plumbing for other fintechs. When another company wants to offer a card or a digital wallet, they often use SoFi's tech. This creates a high-margin recurring revenue stream that is much more like a software company than a bank. This is why comparing them to a traditional individual brokerage often fails. They are hybrid. In the past, SoFi was heavily criticized for its reliance on the student loan market. When the moratoriums hit years ago, the stock got crushed. The expectation was that they would never recover that momentum. But look at the reality today. They have diversified so much that student loans are just one piece of a much larger puzzle. Their Q1 results showed that 43% of new products were opened by existing members. That's a massive efficiency gain. They don't have to pay to acquire that customer twice. That's a level of cross-selling that most traditional banks only dream of. It's why people who do a lot of self-investing are finding the platform so sticky.
If we look at the future outlook, there are two clear paths here. The optimistic reality is that SoFi continues to integrate its primary bid acquisition, becoming the go-to platform for retail capital markets access globally. If they can pull that off, the current valuation of around $20 billion might look very cheap in hindsight. The risk, of course, is the regulatory environment and the macro picture. If we see a hard landing in the economy, any company with a large personal loan book is going to face scrutiny. But so far, their credit quality has remained remarkably resilient, with net cumulative losses staying well within their projected bounds. We're also seeing a lot of competition from the likes of Robinhood stock trading and interactive brokers' fees being cut to the bone. To stay ahead, SoFi is leaning into its robo-advisor and active investing features. They're trying to build the everything app for your wallet. When you look at the SoFi mobile app compared to the Fidelity mobile app, you see two completely different philosophies. One is built for the professional, the other is built for the lifestyle. The market is currently betting that the lifestyle approach is the one that will scale. As we wrap this up, the central theme remains the gap between what the market says and what the numbers show. The expectation is that fintech is a crowded, low-margin space where only the giants like Tesla stock or Nvidia stock can command real premiums. The reality is that SoFi is proving it can be a profitable, high-growth machine that operates more like a tech platform than a traditional lender. Today's price action at $16.02 is a reflection of that reality starting to win the argument. We're seeing a move away from the broken stock narrative toward a proven company narrative. Whether you're using SoFi ETFs or trading individual shares on the Robinhood app, the momentum is hard to ignore right now. In the end, authority in the market comes from seeing the shifts before they become obvious to everyone else. The transition of SoFi from a lender to a global capital markets player is that shift. The short-term noise will always be there. The analyst scripts will flip-flop and the short sellers will find new things to complain about, but the underlying trend of member growth and product cross-buying is the most solid part of the story. If you're looking for investment help or just trying to manage your own intelligent portfolio, keeping an eye on how these fintech giants consolidate power is going to be the defining story of the year. The contrast between the cautious expectations and the aggressive reality of SoFi's expansion is what will likely continue to drive the volatility and opportunity in this name. Stay sharp, watch the volume, and keep an eye on those cost of funds metrics because that's where the real game is being played.